Okay. So in the issuance of stock, we've seen this. W- the company is gonna give up ownership, and it's gonna get some assets, usually cash. Um, Companies issue stock because they want to pay for things. They want to pay for growth. They need working capital, so just money to pay the salaries and stuff. You can argue that the stock-based compensation for employees, instead of giving them stock directly, you can sell stock to the market, get the cash, and then pay your employees that cash, right? That's another way of potentially paying your employees this compensation. Now, it doesn't solve this principal agent problems. You want the employees to hold the stock because they have an incentive for it to go up by performing well at their jobs. But really, it's like, corporate needs to pay employees is one reason why they may issue shares to raise capital for all just like the day-to-day expenses, the working capital that they need to finance the business. Um, I guess just a word on the mechanics. You have uh, these entities called underwriters. They're basically the investment banks. What they're going to do is help the company link to the capital. They're like a broker. They're a middle person. The company, uh, whatever, SpaceX goes to Goldman Sachs and says, "Hey, we need to build this rocket factory. We need $50 billion." Goldman Sachs will say, "Hey, we can raise 30 through the debt market, and we can raise 20 through selling shares." And they will help SpaceX do that. They'll work in the bond market, find investors to place that bond and raise that 30 million. They'll also find equity investors to buy that 20 billion in equity. Okay. And uh, so the investment bank not only will help market it, they will oftentimes also guarantee a certain price for the shares of stock, or guarantee that the capital will get raised because they will put up the money that they can't raise from other investors. Okay, so the company benefits because they get the guarantee that the money will be there. If the company wants a guarantee that they will raise the money, since Goldman Sachs, these companies have a large balance sheet, they can actually give the money to the company. But what the investment bank wants, they're not an investment vehicle where they want to own shares long term. They will temporarily fund that and they'll try to sell it as soon as they can. Sometimes they'll be like, "Well, we're not sure we can sell all the shares, so we'll do our best effort. We're not going to guarantee anything." They will just try to market the shares, and whatever shortfall there is, the company has is will have to just deal with it. But of course, if they commit, they're going to take more fees, right? If they say, "We're definitely going to guarantee you that this money will be there," their fees will be higher. There are now some companies that say, "Screw the investment banks. I don't want to pay their fees. They don't even do a good job of marketing my IPO. I just will sell directly to the market." And this is possible. Like the NASDAQ stock exchange, it allows this much more easy company access to the market because it's all electronic trading and whatever. They have some technology that kind of makes this possible. But this has also been failed. There's some uh, stories where this failed too, because the investment banks do a good job of getting people riled up to buy the shares. So there's a value add that they do have. Okay, and then where do you go to buy shares? Um, there are stock exchanges. Okay, so this is where um, you can go to buy the shares of your company. The New York Stock Exchange, NASDAQ. These are the two main ones in America. New York Stock Exchange is typically like um, non-tech company. A lot of tech companies are on the NASDAQ, like biotech, uh, information tech. But NYC is like, banks, oil and gas. It's got more of the traditional companies that are listed on the New York Stock Exchange. The LSE is the London Stock Exchange. Um, Tokyo Stock Exchange, Euronext is the big one in Europe. Shanghai Stock Exchange. So there's many, companies will list their shares on these various exchanges. And these benefit from network effect. Okay, once you have a large exchange, it's going to attract people to list on your exchange. So it's hard to displace these kind of incumbent exchanges because they have large networks built up. Okay, so par value of stock, as we saw in Amazon, um, before there was regulation in the capital markets, it was like kind of the Wild West. Okay, you had people in America, for the railroads and stuff, selling shares, um, and there was a common scam where uh, someone would sell stock to investors for $1, and then and then those people would think they own some percentage of the company, and then the scammer would just like basically for insiders and like whoever give shares for a much lower price to other people. Okay, and that would dilute those people that paid $1. And if you sold that same share for 1 cent to someone else, then that person got the same percentage ownership for 1/100th of the price, right? So uh, one way that uh, companies gave assurance to their investors is they guaranteed a minimum price for the stock. And this is what the par value historically came from. It was not like regulated. It was just a way for the companies to gain the trust of investors by saying that we will never sell our stock for under X price. And that X price was the par value of the stock. Okay. So now it's totally irrelevant. Okay. We don't have these scams because it's such a issuing shares now is a highly regulated uh, thing. Okay. All the companies that you can invest in, the reason why the government allows them to sell to all of us, the public, is because they're so heavily regulated. Okay. There's so many government officials watching what they do that it's hard for them to run a scam. There are smaller private corporations that do not allow those companies to sell to everyday people. Okay, they can only sell to people that have $1 million net worth, they're sophisticated. There's all these requirements. Okay, um, but if a company is publicly traded, they're the most heavily regulated because there's a history of scammers, which is, you can argue that it's not quite fair because a lot of the private investments are where the returns are much higher. So, and it's only accessible by rich people, So, it's still a little unfair, but it is what it is. It's the government trying to protect people from being scammed because the default, as an aside, political philosophy here, our current system of government assumes people are dumb. Now, is that the correct assumption? You guys be the judge. The government has set up so many things that are there to protect you. Now, are you capable of protecting yourself and being a discerning person in all the things? Consumer goods, right? We have so much regulation on the goods and services that we buy, right? You can't buy a washing machine now that has like analog stuff because the water use regulation, So are people too dumb to figure out what's in their best interest, or do we need government to do it? This is a philosophical question that we all can vote on and decide. The current system is highly regulated, so you don't really need par value. It's kind of a done system now. You saw that Amazon's par value is 1 cent a share. So that's now how it is. They keep it at 1 cent or even a fraction of a cent, 0.001 cent. But how the corporate law, because the laws are all old, some states require you to have a par value. But the companies now just get around it by having some very low, trivial par values. Okay, so the only thing that really changes is we now have an extra journal entry line item. You can see here that this common stock, $1 par value, 3,000 shares. You're going to basically take the number of shares times the par value and have this, and then all the remainder of however much money you raised is going to go into this paid in capital in excess of par. Okay, so again, in this transaction, y- the high level is that you sold 3,000 shares for $4 a share. Okay, so you know that you raised $12,000 total. That's easy. Price per share times the number of shares. Now, what this is going to be dependent on the par value. What would this be if my par value is 1 cent? What would this have been? Exactly, $30, because it's 3,000 times 1 cent. Okay, so this would have been 30, and then what would this have been? Yeah, 11,970. Okay, is everyone good with this? Okay, so quite trivial, I think, but it is what it is. The system still exists, so you should know it. So you can see here, 1 cent par value, and they issued, basically it's this number times 1 cent is how they got this. Okay, all the rest is in this paid in capital, because obviously, Amazon stock is trading for much higher than 1 cent. Right, so all the additional paid in capital is in this account. So these two will be correlated: the par value and the balance in that account. Okay, so there are some no par value stock. It makes then the journal entry is exactly as how we've been doing it. Okay, you don't have to worry about that extra line item. If we exchange stock for an asset, you'll either need to know the market value of the shares. So in this case, the transaction is this. We're giving 4,000 shares for this furniture. Okay. Now, if you had a public company doing this, and let's say the market value was $10 a share, you would basically, you're either going to know the market value of the furniture, or you're going to know the market value of the shares. Okay, that's going to determine what you're going to value this transaction at. Now, which one is more determinable? Like if it's your small little startup, it's probably the market value of the furniture, because the furniture you're going to go to some store and buy it, so you'll know what it's worth. Okay. If it's this like artwork or something, and you're trading your Amazon stock for art, then the Amazon stock is more determinable. If you're giving 100 shares of Amazon stock for this artwork, you'll be able to price this transaction based on the value of the shares, because it's do 100 times $250 and you have the value of the art. So the value of this transaction, again, will be determined by either the value of the shares or the value of the furniture, whichever is easier to determine and more conclusive.